coming week. The 11:50 to 12:10 macro. It's a time of day where the algorithm will begin a price run. It runs for liquidity. Sell side is here. It drops down right there and then goes higher. Let me take you back up to the 5 minutes. That way you know where you're at and get your bearings. We're looking at this run here and drop down between these two blue lines, targeting that initially, but ultimately above June 16, 2023. So those levels here, we're going to look at all of this price action and this run up here. Right now it's on a 5-minute chart. Looking at it now on a 1-minute chart, it looks like this. Here's the relative equal highs. The drop down below the low where the sell side is, and then at 11:50 to 12:10, the algorithm will begin its buy model. It will run higher, trades into the inefficiency. It doesn't look like an inefficiency here on a 1-minute chart, does it? Which is the reason why you have to cycle through time frames. You have to be able to go through a 5, 4, 3, 2, 1 minute chart when you're day trading, because you'll see the inefficiency that the market will reprice to. And then once it does that perfectly, and it's the time of day when we'd expect what? The lunch run on liquidity, that's here. And we're blending, not only is the lunch hour macro reaching up for the buy side, but it's also, this would be a run in the same direction of our higher time frame bias, reaching for the June 16th high. Because in normal instances, like say we were bearish, we would see the market rip up into here, take out the buy side, and then work lower because we're in a bearish sell program on the higher time frame charts. We're not in a bearish sell program. We're in a higher time frame bullish buy program, meaning that that shaded blue area up here, that weekly volume imbalance, and the old high on June 16th, 2023, above that high is going to be buy side. Someone went short. Large funds have liquidity above there. What kind? Buy side, buy stops. They're protecting, they were holding shorts. The algorithm runs against that. It's not running against you. Okay? It's not looking for your order. It's going for where the large fund liquidity is. Or it's running for a higher time frame inefficiency, which is also conveniently allowing that algorithm to reprice against the buy side liquidity resting above June 16, 2023. So this run higher, it gets into here, and you see there's a first partial right above relative equal highs. I'm holding. You want to catch the big runs, the big rips higher and lower, and get the lines portion of the daily range. That's what I show in here. First partial here. Then I took the idea of the high here to that high, and I did gradients, and you'll see that in the execution video. I want to see it reach up into those levels, and I layered out limit orders, and then I had one up in here, and I had one ultimately just below the weekly volume imbalance to see if it can reach for it as a best case scenario. It didn't get that again, ended up coming back down and stopping me out here on the final single contract. If you look at the diagram here, this is my bearish breaker. This is not a break and retest. Okay, it's not an FU candle. It's not a Wyckoff. It is a schematic in terms of understanding how runs on liquidity and then a repricing lower occurs. So what we need to know is, where is liquidity? Now there's two ways to use the breaker. This is a bearish breaker, and what we're understanding with this diagram is there's obviously when you have a market that is predisposed to go lower. If you're anticipating the market going lower, if you're looking for a bear market to provide an additional entry or a point of reference for pyramiding new short positions, this is what you're looking for. Okay, this is one of the strongest PD arrays I have, because the characteristic behind this PD array is that it is acting on pending orders. So if you've ever traded and had your stop run hit and then see it run in your favor after your stop loss was hit, that's what this pattern capitalizes on. It really takes you into the marketplace in terms of a narrative to attack the ill-informed or retail trader that tries to look for continuations, some kind of trend following model. If they have no idea where liquidity is and what the narrative is and why the market should be going lower, they get many times trapped by this move. They will be caught being a buyer of a breakout above a short-term high, And then it only goes up to a higher time frame buy side liquidity where the actual reversal occurs. There's two stages of liquidity for the highest form of precision with my breaker. You'll always have the short-term buy side liquidity above the short-term high, but it's going to want to reach into a higher time frame buy side liquidity, and then you're waiting to see if it runs away from that. And then inside of this price leg from A to B, that right there is what you're looking for targeting. Now, I haven't taught this before. This is the first time. Even my charter members and my private mentorship, which nobody can join anymore, and I don't even make videos for them anymore. Okay, the only thing they get to do is ask me questions. So this A to B leg, we're ignoring all this. This is market protraction. Okay, this is the manipulation. So with this out of the equation, okay, think of this as time distortion. It's running from the low to the high to get that liquidity. But once it does that, ignore it for a second, because this is not the 2022 model. 2022 is something entirely different where you would use this price leg. Oh, you're confusing me, ICT. I understand. If you watch the videos, there's two different approaches being used. Okay, we're using the price leg from A to B. Once this market creates this run here and it starts to drop down, if I trust that I'm on side, that means I'm bearish. Okay, I'm expecting lower prices. I'm already going short when it runs above the buy side. It may not be my biggest position. I might scale in a larger portion. I'll give you an example. The model I've been showing you with trading ES is I'll go in and trade 6 contracts first, and then I'll add 3, and then I'll add 1 for a 10 lot position. So I'm scaling in. This type of trade here, I would go in with 1, add 3 in here, and then 6 on a really good run into the breaker. I'm building in the likelihood of, even if I'm wrong and it goes against me on the 6 contracts, I have 3 and 1 that help offset or mitigate most of the drawdown that would be occurring if it was to quickly reverse and take out that high. I'm not suggesting that you should trade that way, but I am trying to teach you a little bit more in terms of amplification of the breaker pattern, because there's a lot of people on YouTube, there's a lot of people making courses and mentorships, and they really don't know what they're doing, and they're really misguiding people. So to keep you from doing that and to correct you, this is what this lesson's for. I'll have a lot more details about these PD arrays in my books, but I want to give this today. This A to B price leg, you take that leg from the high down to the low, and you lay your Fibonacci on that, and then you do your standard deviations lower. Whatever this range is from here to here, 1 standard deviation lower, that is the easiest bread and butter approach to using the breaker. If you're on side and you know you're looking for it and you're in a bear market, you don't need it to come down into this level here and trade back up. Many times you'll see me annotate a breaker and I'm entering in this price leg running lower before it even breaks out that low, because I'm not a breakout trader. I'm not a break and retest trader. And so everybody thinks that I'm showing when I do a breaker. No, they have no idea. You have no idea if you think that. You have zero understanding of what I'm doing. I could be selling short throughout this entire range using the 2022 model, and then use the breaker as an additional area where I can add and pyramid more. Or I can simply just wait for it to come back down, or you could do that if you want to be very conservative. Wait for it to provide some means to go back up here. Now here's what you're afraid of. What happens if I go short here and it goes right up here or goes into my stop loss and stops me up? You take a loss. How's that for logic? Then you consider, does it still want to go lower? If it does, and nothing's changed, you just got stopped out, you just go in again with half the position size that you used on your first trade. That's all you do, folks. You're not going to avoid a losing trade. It's going to happen. You will lose. Okay? I have losing trades. If I traded every single day, every single session, and tried to trade everything I've ever taught, invariably I would have losing trades. But what I have done over 30 years is I've determined the ones I really favor based on the dynamics in the marketplace at the time, the present narrative, where it's likely to go, where's the next draw on liquidity, what day of the week it is, what time frame, what session, all those things. It's 30 years behind me doing that. So when I talk about things in advance on Twitter and I show you executions, I'm leaning on that 30 years experience. But you don't have 30 years experience. And I'm not trying to talk down or be condescending, but If I try to do everything all the time and through a kitchen sink approach, like many of you try to do, and you get frustrated, I'm looking at the best scenarios because I have the experience to determine that. Your time learning to use these tools, you will do that over time too. It may not take you 30 years, obviously, but I'm telling you, it's going to take you much longer than you probably anticipate or hope to see it require. And it's okay. That's normal. Everyone gets excited about, wanting to go out there and try to use it right away. But you're also dealing with the most ruthless industry in this world. The financial markets, they're not easy for a reason. If it was easy, everybody would be doing it. But this language I'm teaching you allows you to go in and see where there are opportunities for you to go in and exploit these inefficiencies or imbalances. Obviously, like everything I teach, everything can be reversed. And what we want to see here, if we're bullish, this could be a reversal pattern, or it could be a continuation in an existing bull market. Okay, so if we're presently under a buy program and we're expecting higher prices, this can be used intraday. Any time frame, by the way, these patterns form. But you have to understand where there's liquidity. And the best breakers are going to see two levels of sell side. Obviously, the short term that would be created with the short term low here and a rally up, and then a lower drop into a much more significant or higher time frame sell side liquidity. So there's two pools of liquidity that's being engaged here. It's this one by default that makes the breaker, and then we're seeing it reach into another level. The qualifier that I like to see is I already anticipate this liquidity here, a lower draw on liquidity. And I love when it goes down real close to it and starts to rally because I know what that's doing. It's enticing folks to see that that's a time to go long. And this run higher engineers more liquidity below that low and makes this a much more juicier liquidity pool. So it drops aggressively down in here. Once it takes this sell side out, I could be going long if I'm extremely bullish. If I'm on side, I'm trusting all my analysis, everything is indicating that this market, whatever it is going to go higher. I will buy those sell stops. Now, you may not have the confidence to do that. That's okay. You can treat this price run here. You can use the model 2022 to enter in that. Any fair value gap in here that forms, you can anticipate that run. Or use the rules that takes out this high here. Any retracement back in later into that price run, that would be your 2022 real rules. But I can be entering in this without any need to take out that high yet. But once it gets down here, my eye goes right to that leg from A to B. And I run standard deviations off of that. And the easiest bread and butter setup is using the low to the high, being long in here or somewhere in here with a fair value gap or institutional order flow entry drill or inversion fair value gap. Something in this leg here, there would be a fair value gap, retreat it back above it, find some support, target here, and then two legs of this run. So in other words, whatever this low is to this high, add it to this high, up. So that would be one standard deviation of this price range, A to B. That is the easiest, just bread and butter setup. You can literally carve out an income, a career just with that. But the wonderful thing is, it's not limited to that. Little ICT is going to teach you how to take this information and supercharge it. If you understand where the market's going to go on a higher time frame, if you're utilizing something like this pattern here to get in sync with a higher time frame buy model, you can then use the standard deviations between point A and point B and see if they agree with a larger, higher time frame pool of liquidity that you may be utilizing for the ultimate bias or draw that you're reaching for based on a higher time frame trade. So I'll give you examples of that. All right, so here we are looking at where we have opened for this week. Presently, we are at July 2nd, 2023. It's 5 minutes after 6 on this candle here. Time in New York is almost 10 minutes after 6. Always have your charts shown on TradingView with the New York session there. So here we have the low, the high, and this is a 5-minute chart, by the way. Low, high, lower low. So this is a breaker. Inside of this price leg from A to B, remember we're bullish, we're looking for the run from this low to high to do our standard deviations. I've already went through the idea of buying it here because we can be buying inside this leg right there. We don't need to see this high broken and traded back to as support. That is one way of using a breaker. But when you understand where the market's likely to go, you can trade in this run before it happens. So you're not becoming a break and retest type trader like many of the critics will say that I'm teaching you to be. No, and I'm not a break and retest trader. But this low to high to lower low, if you take that A to B leg, you're ignoring this as a run on liquidity. So all of this is time distortion. This drop down is both manipulation and time distortion. You are getting knocked out if you're long and using this as a stop loss. The market comes back down, reprices to that level, does the dirty work of knocking those traders that have a sell stop below here on their long that were maybe briefly profitable, and then drops down, goes against them, stops them out. Most traders will not want to go back in. If you did take a trade like that and you get stopped out, you wait for this type of scenario here where it creates an imbalance. Once it does that, you can be a buyer right there. And trust that we've already did a stop run with this run here below that low. But A to B price leg, you use that for your standard deviations. If I show you the fib, right away you guys can see it. If you want to take notes, and that's what my fib looks like. Okay, from here to here, you start running scenarios where you have a standard deviation of -1. So that's one standard deviation. This leg from here to here projected higher, so it's a measured move. You're not measuring from here to here, you're measuring here to here. So it gives you 44.96.5. That is easy bread and butter setup for an entry right there. We don't even need this high to be broken. But inside this price leg, we're using the up close candles. More specifically, if you look at it like this, we have this level here, so I'm going to annotate that. Okay, so you can see it. And now I'll take this off. This down close candle right there, that disrupts this price run. So it's this range right there. We would use all of that to be a buyer. We would use all of that range there for a return back into the breaker. So this is what you classically see in some of my recordings where I'll show if I think that we're going to go higher and need to pull back into a larger retracement, we wouldn't want to expect that to here because it's number one, it's Friday of last week. It's really close to that June 16th high anyway. So we don't want to see any deep retracements. So what makes me comfortable buying inside of the price leg before a breaker is ever qualified based on my initial teachings in it, and then you see it usually come back and retest it, and then it rallies higher. We don't need that. I don't need that. Sometimes you'll see me annotate the breaker, and I'm getting long right in here and adding to an existing position or entering right away from there because I understand that I'm on side. Everything is indicating that it wants to run to a pool of liquidity or inefficiency above the marketplace. And I'm including the idea that we're on Friday. So the market's going to be in a hurry to get to that liquidity and draw maybe up into that weekly volume imbalance. So we have two real strong factors acting like a magnet, a draw on liquidity, pulling price up. So the algorithm keeps repricing higher. It doesn't matter how many people come in selling short. It does not matter what that volume is. All the sellers can come in all they want. All the book maps, all the level 2 indicators of showing that there's a lot of sellers that want to come in the market. It doesn't matter. The market's going to just keep repricing higher, and you can't fight that. So all this insight here allows you to differentiate how we use my breaker. There is not just one approach to using it. You have to understand the narrative, the day of the week, all the factors involved, and blending a lot of other things, which makes it a little bit more complicated than your classic support and resistance idea that you're already failing with anyway, because you can't qualify retail support and resistance based on what you see in books. With what I'm teaching you, it helps qualify very specific levels of dynamic support and resistance. I'm not a support and resistance trader. I have given you a language so that way you can see how the algorithm itself that delivers price will react and respect specific price levels. Now, if we take this information and go one step further, we have relative equal highs right in here. Okay, see that? So these relative equal highs, what do we see above those relative equal highs? In our mind, we anticipate what? Buy side liquidity. So when it goes above it here, did it take out the buy side at that 44.96.5 that was measured with this range here yet? No. But we can now use this as a qualifier for a new breaker. So it could be reaching up there to go lower. And if it was to do that, we can anticipate how far it's going to retrace lower with the Friday retracement. We can use this information with the breaker for targeting. And not that I would be want to go short, but we can frame if there is going to be like a TGIF trade, where you anticipate the market trading back into the weekly range, which is what we're seeing here. It needs to get to this liquidity before it does that TGIF trade. Okay, a lot of you were anticipating on Twitter, reaching out to me saying TGIF is going to happen, it's going to happen, but you have to see it get to the liquidity and fulfill its weekly range before it wants to pull back in. So where does it give us details for that? If you look at the high here, which doesn't break above that 44.96.5, it trades to it. Look at the high of that candle right there. It's right here. Watch this one up here. It's exactly at 44.96.5. Folks, that's perfect. Remember, that's this A to B. It goes right to that level there, but doesn't go any higher. Then it drops down, and it creates what? A breaker. Right there. So now I'm not trying to go short. I'm watching and trying to see if it wants to reach up into here. But how can you use this information if you want to be a TGIF trader and trade inside the range or the weekly range as a pullback? Look at this breaker here. A, B, and this run higher. This here is just part of this run. So this is inside the range that would take you above. Because look at the bodies. See where they're stopping? These little mohawks. That's what a mohawk is, by the way. Whenever I have a level identified on the chart, if I say mohawk, and I'm usually typing it out in advance, so that way you can anticipate this is going to just do this. And we expect that. That's reasonable, okay? There's going to be some measure of coloring outside the lines that you're going to have to be comfortable with when you're trading. And I have ways of determining where that's likely to occur. My students are learning that, and you're learning it now too. The bodies are saying that, okay, we're not done. It's going to reach higher. Why? Because this standard deviation of 44.96.5 was just simply confirmed one more time with the bodies. That means it's going to go higher. So we would still use this high to that low. Watch what happens. A to B. Why not this one? This one's the same one as this. Look at that low. 44.91.25. You're looking right up here. That low is 44.91.25. It's the same low I'm showing you here. 44.91.25. But what I'm doing is I'm ignoring this high here because it's unfinished. It's going to run higher. It's either going to go to the weekly volume imbalance or run out that high. I don't need to know what that is yet because the A to B leg is already there. This one didn't go lower, but now watch what happens. How low can it retrace with TGIF? 2 standard deviations. Inside this inefficiency, inside of the breaker. Get ready to drop your jaw. Sorry, folks. Dollar Menu mentors trying to teach my stuff don't have the authority to do this. You have the range in which the breaker can pull back into. The low on this candle comes in exactly at 44.80.75. Standard deviation comes in at 44.80.75. Folks, that's perfect. That's not Wyckoff. That's not supply and demand. That's not any other thing out there. This is mine. Okay? This is mine. You're listening to the guy who codified it. I am the person. I'm the engineer. I'm the guy that put this together. This right there, you're seeing it. You're not finding it in books. Okay? I'm writing all the books that's ever going to be made around this right now by teaching it. They're all going to parrot what you're hearing. But that's precision. You are not learning that from anyone else. Look at the date. July 2nd, 2023. Everything changes with breakers after today. You don't know it yet, so don't go out there and start making videos with it, okay? Yeah, you're welcome to go out and start making videos where you observe this phenomenon. That's wonderful, because that'll not only build your confidence and share it with your community, and you're part of my community whether you like it or not, and that is helpful for you to teach yourself to see it, observe it. But you're blending so many things come together. Let's go down to a 1 minute chart. Okay, we're looking at a 1 minute chart. Okay, so now we can see how we're utilizing the upper portion of the breaker here. 1 minute chart. You zero in on the change in the state of delivery, that last candle right there. Inside that last candle, I can be a buyer anywhere in here. I can use that order block. Let me change this. Okay, you see it better now. See this down close candle right there? It's inside of this breaker. It's the last up close candle when we're in the lowest time frame. So you want to strip it down into the range. Remember, we showed this entire run here on the 5 minute chart. But for fine tuning your entry, it's the last up close candle prior to the lower run to there. When it's trading in that range, if I have something else inside of this little pocket of price action, let me show you what I mean by that. I'm going to zoom in here. Masterclass on the Ict breaker. If we look at the high and the low, if we measure that range, okay, and there's gradients to that. Upper quarter, 50% or mean threshold, because it's an order block theory. Breakers are order blocks. And then the low and the lower quarter, okay? Midpoint or mean threshold is 4484.50. Now, if the algorithm is going to allow price to be utilized there to go long, but for smart money, for people that see price like this, what price does this market need to price to get 4484.50? It needs to at least print 4484.25. Inside of this consolidation, it rallies above it and drops back down. What's the low of that candle right there? 4484.25. That allows the spread to not be a hindrance for smart money to go long there. Even if you don't take that as a trade, does the market show a willingness to want to move away from that? Yes, that's a signature. I'm watching that. I'm seeing price do that. I want to see these types of things come into the marketplace to support the idea that we're going to continuously grind towards that buy-sell liquidity and maybe reach up into that weekly volume imbalance. All of these things lead to a better understanding of where price is going to go. And it's important for you to also know that once we're inside order flow, we have inefficiencies. We've seen the long here, and then we're seeing an inefficiency here, but we're bullish. So we're not looking at this as the trade up into here and then sell off. I've seen so many people tweeting things and other folks that are in other mentorships and guys and gals out there trying to put people in shorts like this. They say, oh, it's an inefficiency or it's a good short, and then they have their faces ripped off. What I'm teaching you is how to identify real order flow, understand how the algorithm will reprice, where it's repricing to, and I'm giving you a level of precision that is unrivaled. Look closely. Do you see this low, high, lower low? Remember, I'm long in here. Here. I'm buying all that. All this in here. I'm buying all that stuff right here. I'm buying it there. I'm buying it there. I'm buying it there. What am I utilizing? Look at those levels. Look at them. What am I buying? Consequent encroachment of that 5-minute fair value gap. It's defined by this level and that level. Then I'm buying what? Consequent encroachment of the inversion fair value gap, which is this level here. I expect this to be support and find a point of accumulation to send it higher, to attack buy-sell liquidity and draw up into the high on the 16th of June, 2023. So I'm using these reference points like rungs on a ladder, okay? Or think of it like a mountain climber, okay? I would never climb a mountain. I would never do that. But when climbers are climbing, they're looking for the next anchor point to anchor their rope, or if they're a free climber and they're not using any ropes, which is absolutely madness, they're planning their next grab point. okay, where they're going to reach and grab and hold onto that rock face and pull themselves up higher. Well, I'm looking for all these areas as price presents them. So when price was down here, that fair value gap was already there. So I'm accumulating long positions here, right in the middle of it, which is consequent encouragement of the 5-minute fair value gap, which is these two blue lines. That gap was already there on the 1-minute chart. I want to see it trade up there. Look at the body, respecting it. See it? It's staying inside of that gap. Then it comes back down. I'm buying it when it's in the midpoint of it, right there. See that little halfway point right there? I'm sorry, right there. I'm buying it there. And then I'm buying the low end range of it there. So I'm accumulating and pyramiding with logic. I'm not just, willy-nilly throwing darts and throwing mud at the wall and see what sticks and come back and say, ha, look how smart I am. No, none of this is cherry-picked. This is absolutely engineered. But now, because we can see this low, high, lower low, what else is occurring there? That's a breaker. That's a breaker. I'm utilizing all that framework. I'm going inside this price leg with the support of this idea as a breaker. Because this is an A to B, and this is all distortion and manipulation, I'm using that as the entry point. But I'm going back into this little short-term price leg right here. No way, ICT. You're going to tell me. Yeah, I'm telling you. I'm going to prove it to you too. Low to high. Okay? Now watch. All of this is occurring, by the way, in the 1150 to 1210 macro. Okay? It's a specific sweet period of time where the algorithm will start spooling, reaching for liquidity. You have to understand narrative. Okay? Don't listen to these guys out there that have 1150 or 1210, or maybe my 1050 to 1110 macro times, and they're trying to show you that they're doing something. None of you know what you're talking about. If you're talking about macros, you have no idea what you're doing. Stop spreading misinformation. Okay? I'm not trying to be mean to you. I'm not trying to be rude. Okay? But you literally don't know what you're talking about. But this leg here, that's the A to B on that breaker. If we take that, and we know that buy side liquidity is on June 16th, 2023 high, the daily candle, it's drawing up into that, and maybe even as much as the weekly volume imbalance. So we have this range right here. That what I'm doing in other charts that you don't see me doing, because number one, for a long time I didn't want to share this information. Okay, number one, I'm not obligated to teach it to you. And my charter members who paid me, they're learning this too for the first time. So you're right in here with mentorship. This is mentorship. I'm not doing paid mentorships. There's not going to be an upsell later on, come and join my club. Okay, I don't want to do that anymore. I want you to learn it correctly, and I don't want people that are out there, rebranding my stuff, teaching it incorrectly. If anything is taught outside of what I'm teaching you here, they have no idea what they're talking about. But now we have 3 standard deviations, 4 standard deviations, 5 standard deviations, 6, 7.5. Where does 7.5? Now, if I show you 6.5, that's right at that old high. You see that? 4493.75. That right there tells me that will definitely reach for that liquidity. Remember, 4493.75 is the high of June 16, 2023. What I'm doing is I'm showing you how to take the levels here for standard deviation, and when they agree with a range of liquidity, what do I mean by that? Well, let's take this off. If we look at how the negative 6.5 standard deviation comes in at the daily high at June 16. I know some of you are already like, man, it's just complicated. I understand. Everything's complicated when you first started. When you're in kindergarten, you didn't know how to write. The first few letters in the alphabet was too complicated for you then. Okay, and that's all this is. You're just learning a language. Okay, but what I'm teaching you is we have an expectation that the market will reach up into the liquidity above this high at 4493.75. Remember, that's what I tweeted a couple minutes after 9 o'clock on Friday, to this range up here, which is the weekly volume imbalance. So in that range right there, okay, if we take that range and use all the breakers or any standard deviation idea or approach to look for targeting, you want to see a confluence of levels anywhere in that range. So if we anticipate 0.50, which is based on that A to B price leg here to here. That's where we got that from. So we have that level, then we have 4495.75, and in one, qualifying and confirming that the high on the 16th of June 2023, that is in fact going to be reached for. How far above that level? Well, 4495.75 is a good level, and 4496.5 is a good level. So any one of those two price levels is a good price point to exit. 4495.25, you have to factor in the spread. So I give myself anywhere between 1.5 handles to a half of handle. And if I'm really trying to show off, I'll do 1/4 of a point and try to let the spread do that. But all those levels were based and framed with all this information here. Even though when I'm recording, you'll see the link in the comment section or the description of this video below. You'll see me actually do this trade and manage it throughout the whole process. But I'm utilizing a lot of things that you don't understand. These levels are dynamic, and it's going to pull price to them. All of the calculations that go behind how these algorithms price either commodities, index futures, Forex, all of them are using the information I'm showing you here. This is not a harmonic pattern. It's not some kind of Wyckoff stuff. It's not supply and demand. It's not Elliott wave. It's none of that stuff. It's understanding time first. What time of day is this occurring? The beginning of the lunch hour in New York. The algorithm will reprice against existing liquidity. What did the morning session see? Lower prices. So it's going to roll back on what? The stops that are resting above these relative equal highs. That's why you see me entering a exit of majority of the trade being taken off there. Why did I take the majority of the trade off there? If you think it's going to go up here, ICT, why'd you take the majority? Because it's Friday and I might be wrong. This is a higher time frame target, that weekly volume imbalance. So it doesn't have to deliver that on Friday, but I felt very strongly that the June 16th high would be delivered. But in the event that I'm not correct about that, I got the lion's portion of the move off at a logical place because I'm teaching you to do that very thing. Now, I could have simply took a small portion off here and a larger portion off right here. And then 15 contracts could have came off there, and then my final right there. And then eventually my single contract got stopped out there. And I tweeted where I had my stop and where my target was, which was the weekly volume imbalance just below it. But all that is in the trade execution. All the details are here. This is not market replay. This is not market replay reports where it's fake. Okay. We're not using NinjaTrader where we can pretend to show profitability. This is actual real market executions. These are real-time applications. I mean, you don't see a replay up here. It's real executions. So all this stuff is helpful over time when you're utilizing everything that I've taught. You're going to have to eventually get to the point where you refrain from trying to get the simple right away, figure it out and get out there and start making money, because it doesn't work that way, folks. It does. I promise you it does not work that way. But if you want unbelievable levels of precision, I'm teaching it to you. But it's going to take you some time to get there. But you don't need to have this level of precision. All you need is a simple bread and butter setup. I taught you that tonight using a breaker. You don't need to have the break and retest. I taught you that tonight. I told you how to buy and sell inside of the breaker before it even goes above its trigger point that I've already introduced initially when I taught breakers. So I'll have much more to teach you with each one of these PD arrays. But for now,